If your household income is between $250,000 and $500,000, you still in the most tax pressure bracket in America. You make too much to qualify for most credit, but not enough to ignore the impact of every deduction. In this video, I'm going to show you how to legally and strategically shrink your 2025 tax bill before December 31st. We'll break this down into 5 core parts plus bonus tips at the end. So stay until the end. Part 1, we talk about retirement and health contribution. Part 2, backdoor Roth. Part 3, health saving account. Does that interest you so far? Part 4, charitable planning with donor advice fund. Part 5, education and estate planning with 5 plans. And finally, we will end with bonus tip and a year-end action checklist. So, if you're a high-income professional or small business owner who tired of paying more than your share, stay with me because each section builds on the last. And by the end, you will have a full plan to act on before New Year's Eve. Cheers! So let's look at part 1. Let's start with the first area where many high earners miss deduction on retirement contribution. So let's say you earn $380K a year working in the tax industry, and it's October and they realize they have only contributed about half of what you could have to your 401k. So in 2025, the deferral limit is $23,500 plus an extra $7,700 in catch up if you are 55 or older. So simply by logging into your HR portal and adjusting your contribution percentage, you can ensure that every paycheck between now and December 31st max out the plan. So that change alone would reduce your taxable income by $23,500, saving roughly about $8K to $9K in taxes depending on your state. Now let's layer something more in advance. Let's talk about the Mega Backdoor Roth. So some 401k allow additional after-tax contribution that can be rolled into Roth IRA within the same year. The total contribution limit under Section 415C for 2025 is $70K, including employer match. If your plan supports after-tax contribution and in-service rollovers, you can shift tens of thousands of dollars from taxable to tax-free territory before year close. Before doing that, you want to check your plan rules, verify contribution room, and confirm whether a rollover can be done before the final payroll cycle. Miss it detail meaning waiting another full year. Let's move to part 2, your most weighted part, the backdoor Roth IRA strategy. So if you are, say, a high-income consultant earning about $325K, you have heard of Roth IRA but assume you are not eligible because of the income limit. Here's the reality. So you can still get money into a Roth through a backdoor strategy. So here's the step. 1, open a traditional IRA and contribute $7,000 for 25 or $8,000 if you are 50 or older. Step 2, make sure you have no other pre-tax IRA balances. If you do, rolling them into your 401k before year end to avoid the pro rata rule. Step 3, convert the 7K to a Roth IRA before December 31st. If you want the conversion counted for 24/5. Step 4, you want to keep all documentation and file Form 8606 with your return. So this move doesn't create a deduction now because you move that money from traditional to Roth, but it shelters future growth from taxation forever. Think of it as planting a tax-free tree that will grow for decades without ever needing pruning from the IRS. Next up, let's talk about health account because for high earner, every layer of tax advantage matters. So imagine a household with high deductible health plan, HDHP coverage, contributing just $2,000 a year to the HSA because they didn't think it was worth much. So for 2025, the limit is $4,300 for individual and $8,550 for family, plus $1,000 if you are 55 or older. By adjusting their payroll contribution in October, they can reach the full limit by December 31st, saving on income and FICA tax at the same time. And here the power move, invest the HSA balance instead of letting it sit in cash. So it's like you want to treat it like a stale IRA. So pay small medical bill out of pocket now and let the HSA grow untouched for decades. So every dollar inside compound tax-free and come out tax-free for qualified expenses later in life. If contributing to payroll, you want to make sure the deduction hit before December 31st. If funding directly, you have until April 15, 26 to designate it for tax year 25. Let's move on to part 4. Let's pivot to something that blends generosity with strategy, which is charitable giving through a donor advised fund or DAF. So let's say you are a couple, you're expecting a large year-end bonus and realize you were likely itemized in 2025. So instead of spreading that donation throughout the year, you want to bond charitable contribution into this high income year by transferring 50% of long-term appreciated stock to a DAF donor advised fund in December. Here, why that's powerful. 1. You get immediate deduction in 2025, subject to AGI limit, which is 60% of your AGI for cash gift, 30% on appreciated assets. So 2, you avoid paying capital gain tax on that stock. 3, you still control when the money go to charity over future years. How you implement it. You want to contact your DAF sponsor early and start the transfer process by December 20th to ensure settlement by year end. For checks, ensure they are postmarked by December 31st. For credit card gifts, make sure the charge post before midnight local time. So this strategy works best when you expect a high income year or when you are nearing the standard deduction threshold. So by bunching your donation, you can reclaim deduction that might otherwise be lost. Right now, let's move to education and family planning, our part 5, where you can combine future tuition savings with estate reduction. So let's look at, let's say you are a professional couple in your early 40s wanting to start saving for 2 young children with college expenses. So in 2025, you contribute 80K total in 2 529 plans, 40K each, and elect 5-year front load election under annual gift exclusion of $19,000 per donor, which means the contribution is treated as being made over 5 years, keeping them under the gift tax threshold, while remove that money from their taxable estate today. How can you do it? 1. You want to choose your 529 plan, so either your state plan if other deduction or an out-of-state plan with better investment options. 2. You can fund the account by December 31st, 2025. 3. File Form 709 in 2026 to elect the 5-year treatment. 4. Save your confirmation statement by proof of timing. So even if you live in a state without a 529 deduction, such as Hawaii, you still benefit from tax-free growth and future tax-free withdrawal or qualified education expenses. So this move not only builds a college fund, but also shift wealth to the next generation without triggering federal gift tax. So far, we have covered 5 strategies that can each reduce your 25 tax bill and build long-term tax-free income. So let's recap quickly before moving into bonus opportunity. So 1. Max out your 401k and explore a Mega Backdoor Roth. 2. Use the Backdoor Roth IRA to move after tax dollar into tax-free growth. 2. Fund your HSA to the maximum limit and invest it. 4. Use a donor advised fund to fund charitable gifts. 5. Superfund 529 plan for education and estate planning. So each of these must be implemented before December 31st to count for 2025 tax year. Let's look at some bonus tips for you, especially for high earners to close out in 2025. So number 1, you want to prepay state and property taxes if you live in a high SOAP state. Consider prepaying January 26 property taxes in December 2025 to bunch deductions. Combined with a DAF contribution, it can push you over the standard deduction line for greater tax benefit. Number 2, review bonuses and stock vesting now. Calculate your projected income and confirm you will meet the 100% or 110% safe harbor rule to avoid penalties for estimated tax payments. If you are short, increase your final paycheck withholding in December rather than scrambling with estimate later. Tip number 3, consider Roth conversions in lower income years. If you expect a dip in income next year, plan a Roth conversion now or early in 2026 when your bracket is lower, so to smooth out lifetime tax exposure. Number 4, review stock option and AMC exposure. If you have incentive stock options, coordinate with your tax professional before exercising near year end to avoid alternative minimum tax surprises. Tip number 5, verify every document and deadline. Print or download your payroll confirmation, HSA contribution report, IRA conversion proof, DAF receipt, and 529 statement. Keep them together for your CPA. It will save hours later. Let's finish with a practical year-end checklist to make sure every strategy you have heard today gets implemented on. First, adjust your 401k deferral to hit $23,500 plus any catch-up by your final paycheck. 2, execute any Mega Backdoor Roth rollover if your plan allows. To make sure your Backdoor Roth IRA contribution and conversion done by December 31st. 4, fund your HSA, individual up to $4,300, family up to $8,555. 5, contribute to your donor advice fund or send out charitable gift by year end. 6, fund your 529 plan before December 31st, and 5, Form 709 if you use the 5-year rule. 7, double check if you pay 90% of your 2025 taxes or 100% of last year, or 110% of AGI if your income only exceeds 150K. 8, repay property taxes if it makes sense for your situation. 9, collect documentation for all contributions and transfers. 10, schedule a short check-in with your CPA in January to lock in final number. You have worked hard for your income, now it's time to make it work harder for you. So these 5 strategies, 401k, Backdoor Roth, HSAs, donor advice fund, and 529 client plan are the foundation for smart year planning for high earners. Every one of them have the clock ticking. So by December 31st, 2025, the window closes. For a step-by-step spreadsheet, planners, and checklists to implement everything we covered today, visit Pro Deductions shop on Etsy for ready-to-use digital templates and explore accesswiteinstitute.com for advanced training on year-end tax strategy. Small, timely moves lead to big, lifelong savings. So act now, close out 25 strong, and start a new year ahead of the IS and ahead of the curve. Thank you for watching. I'm Mia. Mahalo. I will see you at the next video.